Hello everyone. I hope you and your family is safe and doing well. Today I'm here to talk about a new NFO which Mirae Asset is coming out with, which is Mirae Asset Hang Seng TECH ETF and Mirae Asset Hang Seng TECH ETF Fund of Fund. These two products, an ETF and a fund of fund, will track the performance of Hang Seng TECH Index, which consists of 30 largest Greater China technology companies listed on Hong Kong Stock Exchange and having high business exposure to at least one of the following tech themes, which are internet including mobile, fintech, cloud, e-commerce, digital, or autonomous. Firstly, let's talk about how Chinese economy has grown, about growth in tech and digital segment, and what are the future prospects and risk involved before we go ahead and talk about the index methodology and the performance in more detail. The Chinese economy has grown at a pace of around 9% in last several decades, making it the fastest sustained expansion by a major economy. Since 2010, Chinese economy has grown from USD 6.1 trillion to USD 14.7 trillion in 2020, clocking a growth of 9.2% in current pricing terms. By 2025, it is projected to grow to almost $23 trillion with a growth of around 9% on an annual basis. Tech and digital segment is one of the areas which has benefited from this meteoric rise, relentless focus on research and development, and zeal to create technology leaders and intent to shift China from a low-cost manufacturing hub to one of the leaders in technology has made contribution of tech and digital rise from 14% in 2005 in Chinese GDP. China filed 58% of patents globally in 2019 and has second most number of unicorn startups and has managed to create several tech giants of its own. Now, this growth has been assisted by the fact that significant percentage of domestic population has adopted the new emerging consumer tech platforms, from e-commerce to gaming, from traveling to fintech, etc. As of 2020, there are around 940 million internet users, 800 million fintech users, 750 million e-commerce users, and so on and so forth. Mobile payment penetration in China is around 80%. The number of users and size of the market is significantly higher than even developed markets like US in several spaces. Even on other tech, China is growing significantly, especially in spaces like Internet of Things, 5G, artificial intelligence, autonomous and electric vehicles, semiconductors, etc. To re-emphasize the focus, in 14th five-year plan, Chinese government has specially focused on core technologies like cloud, artificial intelligence, semiconductors, and hard tech. Focus is to increase the contribution of digital in China's new economic output and to increase the R&D expenditure incrementally by at least 7% every year. These announcements will ensure state as well as companies' continued focus on technology innovation. Hence the size of domestic market, rise of tech-focused ecosystem and big tech companies in China, and continued focus of government on innovation will help soft tech and hard tech companies respectively. Having said that, we also need to acknowledge the risk which is associated with investing in China. Any investment in foreign market faces regulatory, political, local economy, market, and currency risk, etc. In China, right now, tech companies are facing regulatory challenges which most of us are aware about. To give you a background, in last 10-15 years, China allowed tech companies a lot of room to innovate and grow in order to create domestic champions. This freedom allowed companies to implement policies and practices to create, capture, and retain the market. Now, like it's happening in US and Europe, China wants to govern the functioning of these tech companies in order to ensure data privacy, consumer rights, reduce anti-competitive practices, etc. Though it can also be said that one motive is to have a greater control over the working of the tech companies. While similar actions are also happening in West, like in US, in Europe, the pace and ferocity of actions and proposed reforms surprised the investors, which resulted in stock prices of these tech companies taking a plunge. The Hang Seng TECH Index has corrected by around 40% since the regulatory action started. While some may see this as an opportunity to invest at levels which are reasonable, investors should note that these headwinds may continue in future and may take some time to abate. Now let's talk about Hang Seng TECH Index in more detail. The aim of the index is to track performance of 30 largest technology companies listed on Hong Kong Stock Exchange, which are deriving revenue from Greater China region and have high business exposure to at least one of the following tech themes, which are internet including mobile, fintech, cloud, e-commerce, digital, or autonomous. The company should also meet at least one of the below criteria, which is it should have either a technology enabled business, i.e. through internet or mobile platform, or R&D expense to sale more than 5%, or year-on-year revenue growth of more than 10%. The index is reconstituted and reviewed for constituent change on a quarterly basis and has a stock cap of 8%. And one very interesting thing is that a newly listed security will be added to the index if its full market capitalization is within top 10 of the existing constituents on its first day of listing. This ensures that IPOs are included quickly into the index. Based on this methodology, the current portfolio consists of companies catering to several emerging and disruptive technologies like social media, e-commerce, food delivery, fintech, robotics, cloud computing, artificial intelligence, healthcare IT, autonomous and electric vehicles, semiconductors, Internet of Things, among several others. Even after recent 40% correction, the total market cap of these companies is around $1.8 trillion. These companies have an aggregate revenue of around $460 billion and net income of around $45 billion. All these figures are higher than figures for companies which are present in BSE Sensex Index. Now, in terms of performance, post recent regulatory headwinds, when Hang Seng TECH Index has corrected by around 40%, since inception, index has outperformed Nifty 50 by 1.8%, but has underperformed significantly in last 1 year. Looking at calendar year performance, Hang Seng TECH Index has outperformed Nifty 50 Index in 5 out of 7 calendar years, with significant outperformance in 2019 and 20, but stark underperformance in 2018 and 21. This shows that Hang Seng TECH Index has high volatility. Now, if we look at the performance before the regulatory headwinds, as of February 28, 2021, Hang Seng TECH Index outperformed Nifty 50 by around 13% since inception, by around 11.1% in last 5 years, and by 52.2% in last 1 year. This highlights the wealth creation potential of Hang Seng TECH Index, which comes with a higher risk. Because of recent correction, the Hang Seng TECH Index is now trading at 38% discount compared to its historical averages based on 12-month trailing PE. To conclude, Hang Seng TECH Index tracked 30 largest Greater China companies which are part of several emerging technology themes and stand to benefit from the consumption by huge domestic audience and focus on disruptive technologies by the companies themselves and by the Chinese state. Hang Seng TECH Index has outperformed Nifty 50 index in 5 out of 7 calendar years, with significant outperformance in 2019 and 2020, but underperformance in 2018 and 2021 year till date. With recent correction, the Hang Seng TECH Index may provide an attractive investment opportunity at lower valuation. But investors should assess their risk profile before investing in this product, since, as mentioned earlier, the volatility of Chinese market, including Hang Seng TECH Index, has been higher due to regulatory headwinds and other idiosyncratic risk. The NFO of Hang Seng TECH ETF and Hang Seng TECH ETF Fund of Fund is starting on 17th of November. The ETF closes on 29th of November and the NFO of the Fund of Fund closes 2 days later on 1st of December 2021. The ETF scheme reopens for investment on 8th of December and Fund of Fund will reopen on 9th of December. The ETF will get listed within 5 working days from the date of allotment, which is 6th of December. Investor can choose ETF or Fund of Fund for investment based on his or her preference. Thank you for watching this video. We hope for your participation in this NFO if it suits your risk profile. Thank you and take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.